actually, like let's say there's some kind of exemption which is allowed. Okay. Basic and dearness allowance, it is fully taxable. Generally, dearness allowance is paid for government employees. But otherwise, these two components are fully taxable. In the last 3 years, one more change what we've seen is earlier we used to get that medical allowance and the transport allowance. Both has been taken away, done away. Now, if at all, if you're receiving those two, these two components also would be fully taxable. Instead of that, they've added a particular deduction. So that all we will when we will discuss when we address or move towards deduction segment. So what are some of the allowances which carry some degree of exemption? So they are house rent allowance, children education and hostel. Conveyance allowance and transportation allowance, both are different from each other. What exemption is available is for conveyance allowance. Okay, daily allowance, research allowance, and uniform allowance, right? But I'm sure if you're working with a private setup, say with an IT firm or with any research firm, I don't think we would probably be looking at getting uniform allowance or any such allowances. Mostly it is the general allowance, like the most common one is house rent allowance. So what is exempted under house rent allowance? Basically, you would have seen in your salary computation, list down these three things. Actual HRA received, that is point number one. Point number two, whatever is the rent paid by you, subtracted with 10% of salary. So from income tax definition point of view, every time you hear the word salary, please do not think of your overall annual take home or a gross salary. It is always basic plus DA. Okay. So whatever is your rent paid minus 10% of basic plus DA, that is, which is nothing but 10% of salary is how we define it. And third element is depending on which city you are staying in. As per Income Tax Act, there are about 4 broad metro cities, and all other cities are categorized as non-metro city. 50% of basic salary if you're living in metro city, and 40% of basic salary if you're living in non-metro city. Okay. Lowest of these 4 is what is generally taken into consideration as exempted. So generally fairly treated as lowest of 3, that is actual HRA, rent paid minus 10% of salary, 40% or 50% depending on the city where you're staying. Now, please understand all these numbers, what you should take should be in annual terms. So you're paying 20,000 as rent. So 20 into 12, 2,40,000. So take annual numbers. So what happens is the actual HRA, what you receive, minus the lowest of these 3 will be the exemption. The balance amount should be taxable. There are a few things what you need to understand. If your rent, what you're paying is more than 1 lakh rupees per annum, you are supposed to submit the PAN card proof of the, let's say the landlord. So likewise, there are a few other provisions which you actually should keep in mind while dealing with HRA. And the next one, children education allowances and then children hostel expenditure allowance. Remember, both these two are separate. It might sound like a number which is very low. These numbers have not gone through revision from a very long time. So I remember when I was doing my graduation way back 20 years back, the numbers were pretty much the same, right? How much is allowed? 100 rupees per month for a maximum of 2 children. What do we mean by this? Suppose you are working in a company, that company pays you 1,000 rupees every month as children education allowance. So from the 1,000 rupee what you receive, 100 rupee would be exempted, balance 900 rupees will be taxable. So you can claim this 100 rupee per month exemption for a maximum of 2 children. And hostel expenditure is 300 rupees per month, again maximum of 2 children. All these are, we are discussing the exemption limits, not maximum how much you receive. So up to you, up to the company, how much they want to pay. But income tax department is saying, we will give you certain exemption, but that will be only up to a certain limit. So the last and the important one, all other allowances, what you see, be it the conveyance allowance. So what is conveyance allowance? Suppose you are traveling from one city to another city on a business trip. You submit all the bills, the money, what you get paid. All the money you spent on actuals, is completely exempted from tax. You don't have to add it as income from salary or income from business or profession or any other source for that matter. Suppose you're shifting, your job is transferred, you're shifting your location, say from your current place to another place, the money reimbursed for that, or when you travel to some other country, the flight tickets, what you pay and then gets reimbursed, the daily allowance, which is actually incurred upon staying in that particular place. So all these allowances are exempted on actual basis. So when we say uniform allowance, suppose somebody is working in a manufacturing setup where uniform is compulsory, then again, the actual money what you spend would be exempted. So all these are the exemptions available for income from salary and different heads what we receive. Now, very interesting one. These days we receive shares or the stocks from the company. It basically brings in the belongingness of the company or the ownership of the company. How does it get taxed? Please remember, when you receive shares from the company, it gets taxed at two levels. The first level, when you receive it, okay? That means when you're actually purchasing it. So when you're purchasing it, generally many companies sells their share to the employees at a discount. Suppose if a particular company share price is 100 rupees market price on that day, and the company gives you 10% discount, say you are purchasing that at 9, which means being the employee of the company, you are getting that advantage. So the difference of 10 rupees would be added as income from salary to, for that particular year in the year you purchased. Okay. So what happened? 100 rupees is the share price. You bought it for 90 rupees, but you paid tax on the balance 10 rupees. So now what has happened? Effectively, at least from the computation point of view, your purchase price is as good as 100 rupees. So that is when you receive it. When you sell it, you pay capital gains tax. So depending on the shares of it, whether it's listed in India or listed outside India, did you sell it within 1 year, after 1 year, within 3 years, after 3 years? Based on these things, the capital gains component would be treated. This same thing we will cover in the capital gains section. Okay. So basically, just to quickly sum up in 2 lines, ESPP or ESOP is what you receive would be taxed at 2 levels. One, when you receive it at a discounted price, the discount amount would be added as income from salary. Whereas second, when you sell it, okay, when you sell it, you have to pay capital gains. It is again depending on 2 conditions: whether a company is listed in India or not. Second, whether it's a listed company itself or not. And it could be a private limited company giving shares. We have seen many such examples also in the startup ecosystem today. Okay. So that's briefly about income from salary. Please post your questions in the chat box there. We would love to take up as many questions as possible towards the end. So moving on to the next segment, income from house property. So basically the rental income, what we are receiving from a real estate asset, is treated as a rental income. It is for generally the residential properties, or say you might have a small standalone commercial property, you're getting a rent on it. They all come under house property. Suppose, say you provide a nice, very well furnished, very well set up a commercial property, and then where you're also providing security, maintenance, and the entire package, then it is treated as income from business or profession. It would be treated as house property. So basically, this is mainly for residential assets where you're receiving the income. Now, when you look at income from house property, for running the house, the basic compliance requirement would be paying the property tax. So whatever property tax you pay on a particular year is allowed as expenses. So from the overall rent what you have received, remove the expenses component. So that means what is available with us is what we call it as net asset value. So from the net asset value, broadly, you can claim 2 things, 2 deductions which are available. The first one being standard deduction. So standard deduction is nothing but saying, income tax department is saying that, look, you don't have to provide proofs of upkeep and maintenance of the property. We do understand that if you are running a house, there would be out of pocket expenses what you would be incurring, for which we will be giving you a flat 30% deduction. So standard deduction rate is 30% of net annual value. Okay. So after standard deduction, the next one is interest what we pay on housing loan. Okay, this is the next deduction available under section 24B. Now, when you read the word 2 lakhs here or the sentence 2 lakhs here, please read it as that if it is self-occupied property, maximum of 2 lakhs, but if it is a rented property, then there is no limit. Okay. Now, how is that you can plan for taxes, especially if you're living in a big city or even for that matter, tier 2 city? Residential property prices are very expensive. Suppose if you're like you're married, you want to take a housing loan. I mean, don't construct this as advice. Generally, this is how you can plan it up to save taxes, because ownership is there in both the spouses' name. Then both the spouses would pay or contribute for EMIs. Then the 2 lakhs deduction what we are talking is available for every individual. So which means, suppose if it's a 1.2 crore house, and then if the ownership is equal, say 60 lakhs each, and if both of you are paying say 2 lakhs worth of interest in a particular year, both of you can claim. And whatever principal you repay, that gets eligible under section 80C as the deduction which gets computed under section 80C. So paying home loan EMIs always has that benefit. You can pay on the, let's say you can claim deduction under interest payment as well as principal payment. Remember, the interest deduction what is available is on actual payment basis, whereas for property it is on actual payment basis, because generally not many people have the practice of or a habit of paying the property tax every year. There are instances where people would have paid last 2-3 years property tax at once. If this year, if you have paid for all the preceding years, then this year you can claim for all of it. Okay. Now that's briefly about house property. There are two important things you could keep in mind with respect to income from house property. If it's a let out property, then this 2 lakhs limit is not applicable, that you can claim as much as you want. But the condition here is, because you are charging a higher loan interest on the housing loan, if there is a loss in the house property, up to 2 lakh rupees of loss from house property, you can set off against other heads of income. But maximum set off you can do in a year is 2 lakh rupees. In excess of 2 lakh rupees, you have to carry it forward for the next year. So it's allowed to carry up to 8 years. Okay, that's generally how the construct of income from house property would work. Moving on to the next one, capital gains. When we look at capital gains as the head of, let's say income, the first thing is, from the income tax eyes, there are only two types of asset classes. Okay, which are the two types of asset classes? Equity, non-equity. Fixed income, gold, real estate, alternate assets, everything else comes under non-equity category. That means we need to understand what is equity. So whichever is not equity is non-equity, right? That's how the general definition is. For an asset to be categorized as equity for the purpose of taxation, the rule says 65% of the assets, like if the size is 100, 65% must have been invested in Indian listed equities, and that too directly. Only then it would be categorized as equity. Which means all the foreign investments what you have, suppose you have bought the shares of, say, Google, they are listed, but they're not listed in India. So that means it will not be categorized as equity from the taxation point of view. Okay. Or if you're investing in fund of funds, that means what? You're investing in other mutual fund scheme, which invest in other mutual fund schemes. Because they're not investing into equity shares directly, it is categorized as non-equity for the purpose of taxation. If you're holding on to the shares of any private limited company, because they're not listed, they're also non-equity. So which means strictly the equity shares or the regular equity mutual funds, what we see in India, the active funds, passive funds, all of them, only those are the funds which are treated as equity for the purpose of taxation. Okay. Please understand, from the capital gains construct, the taxability or the tax treatment is same for both resident as well as non-resident Indians. So moving on to how are they taxed? I'm sure all of you would have a fair idea. How does it really work? Let's say the entire capital gain can be categorized into two categories, that is short term and long term. Okay. For equity, short term is less than 1 year, and non-equity, it is less than 3 years. Whereas non-equity, when we say non-equity, only exception is for real estate. The definition there is less than 2 years. Okay. Anything other than real estate, non-equity, less than 3 years. Which means when you buy or invest your money in a debt mutual fund scheme, if you're to sell it within 3 years, it would be categorized as short term. You invested in gold, you sold it within 3 years, it will be categorized as short term. Then what is long term? A very nice, funny way of describing. I've seen this in the literature of the income tax department articles as well. Anything which is not short term is long term, and they don't say 1 year. They say 12 months. Remember, when we say it has to complete 12 months, the day of sale is not considered as part of holding period. Which means, suppose you invested in a mutual fund scheme on 1st January. If you sold it on 31st December, would you treat it as 1 year? Generally, from layman terms, yes, why not? But because you sold it on 31st December and 31st December on the day of sale is not considered as part of holding period, then your investments did not complete 1 year. For any investment to be qualified to be as that 1 year or whatever the timeline, remember, exclude the day of redemption. So which means, to be on a safer side, it's always good to redeem on the first or second of, like let's say 367th day or 368th day. That's how ideally you should look at. Again, I'm not recommending you to withdraw after 1 year, but I'm just giving you a scenario. Same is the logic applicable for debt funds as well. So what is the tax treatment? When you look at it for equity, the short-term gains, that is, if you sold it within 12 months, 15% flat, irrespective of what income tax slab you belong to, does not matter. And long-term, up to 1 lakh rupees in a financial year is exempted, and in excess of 1 lakh rupees, you pay 10%. Okay, that is a definition of how much tax you have to pay for equity on short-term, long-term. For anything non-equity, short-term capital gain is as per your marginal tax slab. That means you sold your debt funds within 36 months. That means you have to pay based on the highest tax slab what you are in. Suppose you are in 30% tax slab, then you have to pay flat 30%. And beyond 3 years, what you get is 20% with indexation. So you will get the indexation benefit. So what is indexation? Indexation is nothing but, suppose you bought a property 5 years back, say by paying 30 lakh rupees. So small property, small piece of land, let's say paid 30 lakh rupees, you bought it 5 years back. Today you're selling it. Let's not worry about the selling price. But income tax department would ask you to pay income tax as on today, but you paid this 30 lakh rupees 5 years back. Which means we are comparing the money what we had 5 years back to the money what we are getting today. It sounds a little unfair, isn't it? So that is why income tax department allows us to bring up the cost of purchase to as on today's date. Okay, use the inflation index number and then calculate how much you think this 30 lakh rupees would be worth today. That's what we mean by indexation. Indexation is a tool which helps the investor. This will bring up the purchase price. So the moment you bring up the purchase price, your gain will reduce and your tax liability also would reduce. That is one of the biggest advantage what generally debt funds and investments in gold would have compared to other investments. Okay. So this is capital gain. So what is capital gain? You had an asset, you sold it, you made money, and on that you have to pay taxes. The next question is there a way you can save this particular capital gain tax? Okay, I mean, everybody would love an opportunity to save tax, but for capital gain savings, there is a specific head, what we call it as Section 54, and then series under Section 54. The first section, Section 54 says, it talks about if you have an old house and you sold that old house, whatever gains if you have made in that old house, if you were to invest that in a new residential house, whatever money you have invested, to that extent, you can claim, like let's say exemption. So you don't have to pay capital gains tax on that. Okay. This particular rule is applicable only for individuals, or HUF only, not for any other category of individuals. I'm talking about section 54. And interesting thing is, section 54 does not say how many houses you should own. So you can own any number of houses. There's no restriction. But from the capital gain, whatever you made from the old house, when you're buying a new house, ideally you should buy only one property. Okay. There's also an exception to that. If the total capital gain is 2 crore or less than that, then you can buy two houses as well. But buying two houses at once is a once in a lifetime deal. If you just buy it once now, next year or anytime in the future, you cannot claim same deal of saying that, okay, my total capital gain is 2 crore or less than that, I want to buy two houses. No. So general assumption is only sell one residential house, buy another residential house, you claim the exemption. Okay. Now, you can even buy or you can even construct. And when we say buy, it could be from the date of sale, that is today, it could be 1 year before. You could have purchased it 6 months back, 9 months back, any year before 1 year, or 2 years after. Okay. And when it comes to the matter of construction, so from today, you will have 3 years time to complete the construction of the houses. Like when I say from today, please treat it as date of transfer or sale of your current property. Okay, that is section 54. Remember, simple: selling one residential house, buying another residential house. The second one is section 54 EC. This talks about whatever capital gains you have made. If you have to invest this particular capital gain, okay, any tax assessee. Again, this does not differentiate between individual HUF. It could be any type of tax assessee. Whatever capital gain they would have, any long-term capital asset. It could be mutual funds, debt funds, gold, anything. If you were to buy capital gain savings bond, which is under section 54 EC, then you can claim the deduction here, or it will help you in saving the capital gains tax. The rules: you should have done the investment within the period of 6 months from the date of sale, and these bonds are locked in for 5 years. Maximum limit is 50 lakhs. You cannot invest more than 50 lakhs. But most of the capital gains savings bonds generally carry a good credit rating, but the interest rate what they offer as of today is about 5%. So generally, some people might find it okay. Some people might say it's not so attractive, but I would leave it to you. There is this option where you can save tax by investing in capital gain savings bond. Third one is 54F, where you sell any long-term asset. Okay, again, this is applicable for individuals and HUF. You sell any long-term asset, the gains arising out of that long-term asset. If you were to buy a residential house, you can claim for exemption. Okay. Now, for you to claim that exemption, again, the same rules apply. Purchase of a house 1 year before or 2 years after. Construction of the property from the date of sale within 3 years. Remember, you can claim this exemption under section 54F only if you own only one house or no house. If you own more than one house, then you will not get you will not be eligible for claiming the exemption under this particular section. Okay, so that's how basically section 54F would work. There are a couple of other sections, but these are the three important sections where I felt you all should know there is a way where you can save capital gains tax as well. Okay, and the last head is income from other sources. The dividend what we receive, interest on savings bank account, interest from fixed deposits, interest from any other form of fixed income instruments, all of them come under income from other sources. Okay, so when we talk about income from other sources, the savings bank account interest what you earn, up to maximum of like up to 10,000 rupees, you get an exemption. In excess of 10,000, the entire amount is taxable. Okay, the entire interest is taxable. Suppose in a year your savings bank account interest is 9,999, then you don't have to pay any tax. But if it is 10,001 rupee, then you pay the tax on entire 10,001. It is not like there's a partial exemption up to 10,000. Whereas interest what you earn on deposits, what we spoke is savings account. Now we are moving on to deposits. All the interest what you earn from bank deposits, there is a TDS, that is tax deducted at source at 10%. Does not mean that tax rate is only 10%. You have to show it as income from other sources, add it to the total income, like income from all other sources as well. And then based on the slab, you pay the taxes. Okay. Next, dividends from the stocks and mutual fund schemes. Earlier, we had a lot of these provisions, right? Dividend distribution tax, income dividends up to 10 lakh rupees. You don't have to pay in tax. All those things are gone. Now, to put it in a very simple term, dividends are taxable in the hands of the investors. But dividend received up to 5,000 rupees, there's no TDS. That means a mutual fund company or a stock, if they're giving dividends, if you prove to them that your total dividend, what you're receiving in a year is less than 5,000, then there is no TDS. But if the dividend paid out is in excess of 5,000, then again 10% TDS is charged on the dividends as well. So essentially, all the heads of income what you receive, you allow those exemptions, say HRA exemption, capital gain exemption, and then income from house property computation. You just set aside capital gain because the tax applicable rates are different. But all other sources, income from salary, house property, other sources, you club all of them and arrive at what we call it as the total income which is available for taxes. Okay. Now, from the money what is available for tax, there are certain deductions which are available. Okay. So what are those deductions? The first one being standard deduction. Standard deduction, I don't think you have to really worry about it. This is applicable for everyone. Just flat that standard deduction is given. Then moving on to the next one, that is section 80C, 80CCD, 80DE, and 24B. So these are the general broad list of deductions what you and me get to see on a day-to-day life. If someone is into donation, then 80G also can be added. So what are these deductions? The first one is primarily 80C, I think, which most of us are familiar with, where any investment what we make, which are like let's say qualified under section 80C, a deduction up to maximum 1.5 lakh rupees, you can claim. That's the maximum limit. The employee provident fund contribution done by an employee, your contribution, not the employer contribution. Life insurance premium, what we pay, public provident fund, national saving like certificate, ELSS mutual fund schemes, Sukanya Samriddhi Yojana, okay, and principal repayment towards housing loan, tuition fee, the kids' tuition fee. All these are the items which covered under section 80C. Remember, maximum is 1.5. In today's world, I don't think it's too difficult for us to achieve this kind of a number if we are little disciplined or probably little planned, say from the new financial year or the beginning of financial year. This is 80C. Moving on to the next two categories, that is 80CCD and 80D, two major ones. 80CCD deals with our contribution into national pension scheme. Okay, up to 50,000 rupees is allowed as deduction. Remember, this 50,000 rupees is over and above 1.5 lakhs. So under section 80C, 1.5 lakhs, 80CCD, additional 50,000. Let's assume a scenario where you don't have any other 80C investments, but whereas you have NPS investment up to 2 lakhs, then you can use this 2 lakhs for both 80C as well as 80CCD and make it up as total 80C, 80CCD investments. 80D, that is medical insurance payment, the premium paid on like let's say self and for parents. Now the limit has increased to 75,000. On self it is 25, parents 50, so that you can go up to 75,000 rupees. If you're paying from your side, then this particular exemption is possible. Third one is 80E. 80E deals with education loan. Suppose somebody just finished their education or went on an MBA and then came back, now you're paying education loan. Whatever interest you're paying, the entire interest what you're paying deduction under section 80E. Remember, it's only the interest payment, not the loan repayment. Okay, loan repayment would also mean principal plus the interest. New addition to the list of deductions, 80EEB. 80EEB deals with if you were to purchase electric vehicles. Okay, again, this particular exemption or deduction only for individuals. Okay, not for HUF or any other category of like let's say individuals here. Maximum limit is 1.5 lakh rupees. Okay, that's the like limit is what is available. But provided you've taken the loan or loan is sanctioned between 1st April 19 to 31st March 2023. So that means even if you were to buy a new EV next year, you can claim deduction under Section 80 EEB. Okay, and I'm repeating this again. Section 24B, interest on housing loans, self-occupied property 2 lakhs, and like let's say rented out property, then there is no limit. So all these are the deductions which are actually available. So from your total income, what we arrived, then you allow all the deductions. The moment deductions are allowed, then your overall taxable income reduces. I'm sure that's why we save tax, right? All these investments in order to save tax. So before we finally jump into what are the different, like let's say tax regime we have, which one is beneficial, where we have done some illustration. I just want to cover what are the tax treatment for different investment options. Okay. So the first one is dividends. I think dividends we have discussed already. Dividends are taxable in our hands as investors. The question of DDT now does not arise. It's completely taxable in our hands and income from other sources, but dividend payment is in excess of 5,000 rupees. TDS of 10% is deducted. Okay. Again, taxation TDS rate for non-residents is 20%, but again, because of double taxation avoidance agreement, like let's say if the non-resident investor were to provide certain proof, this TDS amount can be brought down to 10. Tax residency certificate, Form 10F, copy of PAN attested, and self-declaration form. All these things will bring down the TDS rate from 20% to 10%. Okay. Then when we look at investment opportunities, fixed deposits versus debt mutual funds. Okay. So when we say mutual funds, please read it as debt mutual fund. So we always, in general, compare fixed deposits versus debt mutual fund schemes. Yes, that's a reasonably fair comparison. Suppose if you're looking at investing in FD for 1 year, the alternates could be low duration fund, money market funds, and all these are options which are available. Now, apart from the return difference, the one and a very big difference here with respect to fixed deposit versus debt fund is how the income what you earn from these two different investment options are different. First one, suppose if I have invested in an FD for 5 years, and if whatever interest I am earning, whether you receive the interest or not, it is taxed on accrual basis. On that year, whatever interest you have earned, whether you're withdrawn or not, you pay tax on that year. So the moment you hold FD, you pay tax every year. Whereas in mutual funds, because it is like it carries that NAV, the market risk and everything, you don't have to pay tax on accrual basis. You pay tax only when you redeem it. So that means if you held on to debt funds, till the time you redeem the money, you don't really have to worry about paying the taxes. And a very big advantage here is the taxed, what kind of tax rate which is applicable. Suppose if your income is say more than 10 lakhs, that means essentially you're falling under 30% tax slab as per old regime. Then you pay 30% on fixed deposit. I mean, that after allowing all the deductions, then you go by the slab, then you pay 30%. Whereas for debt funds, what you pay is flat 20%. That too after adjusting the indexation. Okay. For example, if I've invested 1 crore in a debt mutual fund scheme 5 years back at 7%, if you see using the indexation method, if I sold in 2021 5 years back, then my cost of acquisition, that 1 crore would have become 1 crore 20 lakhs. So if I had redeemed 1 crore 40 lakhs, then my gain would have actually been only 20 lakhs because of this particular indexation. So when you bring up the cost of purchase, the overall gains reduce. On gains only you have to pay 20%, that to a flat rate. Okay, so from that point of view, the overall return, the net return what you earn from debt mutual fund schemes could be slightly higher compared to fixed deposits. And finally, very important one with respect to how does the SWP would help in terms of let's say tax planning. we say SWP, systematic withdrawal plan. Just 1 minute. Let me just share a small illustration to you on how does the SWP would work. Okay. Yeah. Can you all see the screen here? Ojit, if you're there, can you confirm, please? Can you see the Excel sheet?
No, Karthik, we are not able to see it.
Just 1 minute. I think it's still taking time. Can you now?
Yes.
Yeah. Can you see? Okay, great. There are too many columns. Don't focus on all. I'll just guide you through. Suppose you invested 50 lakh rupees in a equity hybrid fund on 1st April 2019. Okay, let's just start with that. And you want to withdraw money systematically, regularly every month, but you didn't want to withdraw immediately. You wanted the money value to grow. Okay. But so for that, you left your money in the investments for 1 year. But during this 1 year, because of the 2020 market fall, this 50 lakhs did not actually appreciate. It actually depreciated. It is only 47 lakhs. This could be one scenario, almost 48 lakhs. The NAV of the fund was 135 rupees. I've taken an example of an actual fund. So the number of units what we got was 37,000 units. And let's assume that every month you wanted 40,000 rupees, what you wanted. So what I've done is from the, like let's say number of units which is available, I'm withdrawing 40,000 units. So that means effectively, this is the number of units what I'm withdrawing every month. Okay. So from 37,010 units in the first month, that is 1st April 2020, I withdrew 387 units. This is the number of units remaining, and then this is how the maths is working. So like this 47 lakhs became 37, 41 and all that. Don't worry too much about the mathematics or number behind it. All we are simply doing is there is a particular equity hybrid fund on which the fund NAV is changing. If you see 137 going down to 103, then subsequently going back up again. Every month, what are you doing? You're withdrawing on 1st of every month, you withdraw 40,000 rupees. And next year, just to match up with the inflation, you're adding 6% more to your withdrawal. So second year, you're withdrawing 42,400 rupees every month. So technically speaking, let's assume instead of losses, if you have made gains here. So actually by the end of this year, so what happens? 40,000 into 12, 4,80,000 rupees essentially is what you would have withdrawn. And generally how we would think is, Acha, 4,80,000 I have withdrawn and I have to pay tax on it because I have withdrawn only the gains. But that's not how income tax department would look at it. When you withdraw this 40,000 rupees, for every component of this 40,000, what is your investment amount? What is your gain? Okay, that is how income tax department is going to look at, and they're going to ask you to pay tax only on the gains. Okay, that means how many units did we redeem? 387 units. Okay, now 380 units, 387 units. What was the profit we made? The profit we made was I redeemed at 103 rupees. Okay, minus my purchase price was 135.1. So if I sell a unit for 103 rupees, the one which I bought it for 103, that means 135, that means I'm making losses. If you see the first month withdrawal, there is a capital loss. There's no capital gain of 12,000 rupees. Okay, if I did the same thing for all the, like let's say years, it would look like this. All the months, it would look like this. How did it look like? During the first 12 months, that is from 1st April 2010, 2020 to, like let's say 31st March 2021, one financial year, considering all the gains and losses, my total withdrawal of the value, whether capital gain or capital loss, if you see this, when I add this up, it is actually coming to 16,024 rupees as capital loss. Whereas if you look at the second leg, that is the next financial year, because markets did really well in the year 21, 22, my gains would have looked like this. So first year, how much tax do we have to pay? There is a capital loss. You don't have to worry about paying any tax here. Okay, even though your investment value is 57 lakh rupees at the end of second year, you have withdrawn 4 lakh 80,000 rupees, but still, because of adjustment towards principal and the interest, you don't have to pay any tax. Second year is the what is the value here? Second year, we have withdrawn 4 lakh not sorry 42,400 for 12 months. Okay, I have withdrawn 1,49,000 rupees in the second financial year. But here, what does the equity taxation says? Up to 1 lakh rupees is exempted. Let's assume there is no other redemption, it's only this redemption. So on 1,49,486, you remove 1 lakh rupees. Okay, that's the exemption what is already available. Plus, let's assume last year's capital loss, you can also set off this year. Okay, that means there was no other income. Last year you had a capital loss. You reduce your this year's capital gain with last year's capital loss. So that means, sorry, this is minus to minus become plus. Let's just. So effectively, your taxable capital gain is only 33,000 rupees. On this, you pay 10%. Okay, so on this you pay 10%, which works out to 3,300 rupees. Okay, 3,366. Whereas if this was bank deposits or any other form of fixed income instrument, on entire 1,49,000 rupees, you would have paid the taxes. So generally, that's how it would work. Okay. And the final question, which regime to opt for, right? We have two tax regimes as per old tax slabs, as per new tax slab. Just by looking at it, new tax slab looks very interesting because the slab rate slowly start jumping from 5%, 10, 15, 20, 25, 30. 15 lakhs and above, it turns out to be 30%, whereas old tax slab, 10 lakhs and above turns 30%. Suddenly, old tax slab looks very unattractive. But the reality is, in new tax slab, no exemptions and deductions are allowed except NPS. There is no other deductions allowed, ATC, ATD, or HRA, no exemptions and deductions allowed. So then that means for someone who's already doing some form of investment, as a salaried individual, if you're receiving, like let's say different heads of, like items what you receive, which are partially exempted, then essentially by opting for new tax slab, you end up paying higher tax. Okay. Just shown a small illustration here. Suppose if you have received, if your total taxable income is 7,50,000 rupees. Okay. And what are the deductions you are using? Standard deduction of 50,000 rupees. ATC of 1.5 lakhs. That means 2 lakhs. ATCCD, that is NPS 50,000, and ATD, that is you are not paying premium for your parent. Let's say for yourself 25,000. So entire value is how much? So 50 plus 150 is 2.5, 275. That means total 2,75,000 rupees worth deductions you are claiming. So as per old tax regime, 4,75,000 rupees would become your taxable income. New regime, because there are no deductions allowed, it is still 7.5 lakhs only. Look at the tax difference. What you pay in old regime is nil. What you pay in old regime is nil. New regime is 39,000. So the difference is 39. So likewise, for every different increase in income, what is the difference? So if you take 12.5 lakhs, at 12.5 lakhs, difference is still very interesting. Your taxable income is 12.5 lakhs. Because of deductions now of 2,75,000, it comes down to 975. So the moment it is 975, you are at 20% slab.
Sorry to interrupt.
Yeah.
Can you please change your screen? It is still showing up the Excel.
Oh, okay. I shared the entire screen.
Thank you.
Is it visible now, Ajus? Is it PPT?
Not yet.
Yeah. Is it visible now?
Yes, now we can see it.
Okay. Sorry. I was explaining if you are under 7.5 lakhs with 2,75,000 as total deductions claimed, how much tax you would have paid. If you see the first row here, the difference is 39,000 under new regime. Old regime, you would not have paid any tax because your taxable income is still less than 5 lakhs after allowing deductions. If you see 12.5 lakhs, you adjust 275 as deductions you would have saved. So 9,75,000 would be your income under old regime, and new regime would still remain as 1250. So the tax difference is 18,200. So if you see, even though with income increasing because of the deductions, you would still save about 7,800 rupees approximately as like let's say income tax every year. Okay, so that's the old regime and new regime computation. Okay, so generally that's what we wanted to cover in terms of what are the different sets of heads of income available, what are the provisions which are there for you to save the tax, and then finally, like let's say which regime to save for or opt for. I personally think as a individual, if you have exemptions and deductions which are there, then it's a no-brainer that you should be opting for, like I say, old regime. New regime is still yet to become effective. So on that note, let's open the floor for questions. I'll be more than happy to take if there are any questions.
So thank you, Karthik. We do have a few questions.
Yeah.
The first one is regarding employee stock purchase plan.
Yeah.
So the question is, what is STCG and LTCG duration for foreign listed company employee stock purchase plan?
3 years, 36 months. From the date of you vesting, that means from the date you purchase the share, if you sold it within 36 months, it would be categorized as short term. And if it is in excess of 36 months, it would be treated as long term. Okay, so remember 36 months for STCG and LTCG.
Thank you, Karthik. The next question is, I have bought a house, under construction house, and the possession is due in February 2023. Can I claim HRA and home loan interest exemption together for the financial year 22-23? Both the houses are located in the same city. Do I need to submit any proof to the IT department that the possession is done in the financial year?
No, you can still claim. I mean, you don't have to provide, sorry, when I meant no, you don't have to provide or submit any proofs. You can own a house and still claim HRA in the same city. There is no restriction. The only condition for claiming exemption under HRA is you need to be paying rent. That's it. It's as simple as that. You can still, let's say, have a completely ready house. Say, imagine a city like Bangalore. Your house is, say, in Malleshwaram, but your workplace is Whitefield. And if you've taken up a house in Whitefield for convenience purpose, even then you can claim. There's no restriction.
All right. So the next question was regarding the arbitrage funds. So the arbitrage funds will be treated as an equity or debt for taxation purpose. And if held for less than 1 year, what will be the tax implication?
Arbitrage fund, it's two phases what we need to understand. First phase is your expectation of returns. Expect the returns like liquid funds, but tax treatment is of equity fund. Okay, because arbitrage fund invests your money in equity shares, that is cash market, and they buy futures of the same shares. So because of this structure, it is treated as equity for the purpose of taxation. So if you sold it within 1 year, then you pay flat 15%, irrespective of your tax slab.
Okay, thank you for this. And we have a next question. So NPS deducted from salary, 10% of basic directly from the company. Under which head will be getting the tax exemption?
The contribution what you would be making, not the contribution which the employer makes. What you would be making, ATCCD, and you can claim also under ATC. Both can be done.
Okay, so you mean that the employer's contribution is always tax exempted?
You cannot claim deduction on it, employer. So when the employer is paying, you can't claim deduction. For you to claim deduction, only on your contribution you can claim the deduction.
Okay, all right. So
Any other question? Yes.
Yeah. If anyone has any questions, then they can raise their hand and we can unmute them.
There's someone who's raised a hand.
Yes. Gurudev, now you can try unmuting yourself. Gurudev, are you able to try unmuting yourself?
Am I audible to you?
You're audible. Yes, please go ahead.
Yeah. So, hey, Kartik, thank you. So what happened is I have sold some of my ESPP, which is foreign invested, foreign equity. So last year, my income tax planner, he told me that 2 year is the long-term gain duration. So I have sold them after 2 years. So he has calculated the tax on the long-term gain. But you are saying that long-term capital gain duration is 36 months. So is that correct? And how can I correct that in this?
Just a moment. I think it is. Probably we can get back to you on this if that's okay. I mean, let me just cross check since there is a doubt element there.
Okay, thank you. Sure.
If that's okay with you, then I will.
Yeah, sure. Thank you.
Sure.
Do we have any other questions?
No, I'm good. Thank you.
Okay. All right. So with this, I would like to thank all of you for coming here. I just take a minute in summarizing the main topics we have covered during our session. So the first topic was regarding the income streams and their tax statuses. Then we have gone through HRA, employee stock options plan and employee stock purchase plans. Then the long-term and short-term gains for equity and non-equity assets was explained very nicely, Karthik. Thank you for that. The tax treatment for various investment options was very neatly covered. And I like the comparison between the FDs and debt mutual funds. So that was really insightful. With this, I would like to conclude the session and thank our expert, Mr. Karthik, for